Brian, thanks for joining us. Bonds have suddenly become attractive to a lot of people, but does that mean treasuries, or does that mean high-grade investment bonds, or does that mean yes to both of them?
Well, I guess a very simple answer is yes. But yes, it's very exciting. Fixed income is attractive. It's in the game. It's an alternative. It's an asset alternative where it hasn't been in a while. So I think treasuries are a fine place to start, but there's no reason to stop there. You can get great yields in investment grade, municipal bonds, select emerging markets. I mean, credit markets have cheapened a lot too. But I think treasuries are a great place to start, down 15 to 20% on the year. One of the biggest moves we've ever seen.
Yeah, and are we being compensated enough? In other words, is the yield that I'm going to get from a high-grade investment bond, call it 6%, but I've got more probably move in the Fed funds coming. Am I going to be compensated enough right now to make up for that spread if it moves?
I think so, because I think if you look at the inversion and what's coming, we're going to have slower growth. We're going to have slower inflation. It's going to be sticky. So the Fed is going to be forced to keep rates higher than they want for longer, which means a bigger slowdown, lower long-term interest rates. I think you're in the middle of a bond rally. So that 6% you're going to get, you can get some duration return, call it another 3 or 4%, and that 6% coupon I don't think has a big risk of default. So yes, I think that 6% plus some duration rally is actually a pretty good return versus other alternatives.
Are you getting a lot of questions from, we'll call them a little, clients that are eyeballing some of these, high junk things that are yielding 9 or 12%? It looks juicy.
It looks juicy. And listen, I think there's been so much shock in the markets this year. Remember, having one of the worst years ever, if not the worst year ever in fixed income. I think a lot of investors are still a little shocked. So yeah, you do get those phone calls. Should I buy things that are juicier, riskier, get into double digits? And the answer is eventually. There are certainly some things that you can buy out there that are attractive. But I think listen, agency mortgage securities, which have the government guarantee, 6.5 to 7%, right? So it's really hard to convince me that you need to extend out the risk curve when low risk stuff is as cheap as it is.
Yeah, and would you dive into the high yield sort of highest quality junk market right now? Would you do it?
And it's funny, people have. That's the one place in high yield where people have continued to jump in. So it's actually probably done too well versus investment grade. They may be splitting hairs. So yes, I think that stuff has great yield. I think it's attractive. I think in a slowdown, if treasuries rally, you'll get your income, maybe not a lot more. So again, it wouldn't be my first choice. But I think if you add a lot of high grade fixed income and then sprinkle in some things with more yield, you actually have a very attractive portfolio that could compete with some of equity markets out there.
Yeah, and on treasuries, and I don't want to, this may be a little bit wonky, or I don't want to put you on the spot. I have a buddy of mine who's far more successful than I am, and he told me that he bought all these 2-year treasuries direct from the government, and yeah, he's getting 4.5%, and it's state income tax free. He was nearly like dancing around the room.
Well, I think if you're real tax-free, the muni bond market has a ton of opportunities in that 5 to 7% tax-adjusted range. But absolutely, treasuries to me, listen, we were 4.5% 10-year notes a few weeks ago, so now we're 3.80. I think we're going to 3.25. 2-year notes will give you good income, so it depends how safe you want to be. But I do think bonds, for the first time in a long time, give you both income and a chance for appreciation. That will be around for a little while, but probably not too long.